A glass half full, with a new president and a vaccine on the horizon. This is Bloomberg Wall Street Week. I'm David Westin. This week, contributors Larry Summers of Harvard and Afsaneh Beschloss of RockCreek. Former Federal Reserve Governor Dan Tarullo of Harvard. Nobel Laureate Paul Romer of NYU.
There is something deeper, structural, that we have to address.
Steve Rattner of Willett Advisors. And Tom Montag and Ann Finucane of Bank of America.
The generations that are coming up want this. They want people to do these types of things. They want us to do ESG.
All of them are asking about this. All of them expect for you to be progressive in this regard.
It felt like we took a turn this week toward a new president-elect who called for unity.
This election is over. It's time to put aside the partisanship and the rhetoric that designed to demonize one another.
Toward a new Congress that looks like it won't go too far out on the progressive wing, and toward a promising vaccine candidate from Pfizer and BioNTech that initial data suggested could be much more effective than we'd thought.
It surely would be helpful even if we could reduce minor illness. But what we're really looking at is what will it do for really serious illness?
And so the markets were pretty much off to the races, and Treasury yields signaled better times lay ahead, at least until the end of the week. But is there a half-empty part of that glass that we're looking past, with continued division in a country still led by a president who won't concede that he's lost?
It will be a smooth transition to a second Trump administration. All right, we're ready.
And a coronavirus that is growing faster than we've ever seen it, and with much worse on the way before it gets better.
There's a need for bold action to fight this pandemic. We're still facing a very dark winter.
For a reality check, we welcome now our special Wall Street Week contributor Larry Summers and Steve Rattner, the chairman and CEO of Willett Advisors, which manages the private and philanthropic funds for our founder and majority owner, Michael R. Bloomberg. So welcome to both of you. Larry, let me start with you. It's the question I've been asking myself all week long. Are the markets getting ahead of themselves? We've got record numbers here at the end of the week from the S&P and the Russell as well. We got that promise of vaccine, but at the same time, we have 150,000 new cases a day at this point in the United States.
Who knows for sure, but I think it's important to remember that at least 90% of the value of the market, and probably 95% of the value of the market, is from earnings that companies are going to generate sometime after 9 months from now. And as long as that's true, it's really long-run prospects that matter more than short-run prospects. And I think the vaccine is a big deal in that regard. I think the fact that we're going to have a transition of power in America is a big deal in that regard. So while I feel much worse about the grimness of the winter than I did a week or 10 days ago, I feel better about the long-run future of the prospects, at least for corporations in the United States. I think the combination of the fact that we're going to have a more stable government, and whether it's good or bad ultimately, and I've got reservations about it, they're going to be more stymied in their abilities to promote inequality in the Congress. That combination is pretty benign from the point of view of corporate interests, and that's, of course, what the stock market reflects.
Yeah, and Steve, what about that transition? It's not as abrupt a transition as we thought. It looks right now, at least, like the Senate may well remain in Republican hands. What does that say about the possibility of stimulus, which a lot of people thought we needed rather badly, including to deal with the COVID-19 problem?
Yeah, I think I agree with everything Larry said, and I think adding stimulus or lack of stimulus into the equation is an important part of trying to understand the market. I'm not going to make short-term predictions either, but I would note that essentially on the same day, we had the announcement of the vaccine and we had the news that we were going to have divided government, which the market, I think, correctly interpreted to mean we were going to have a lot less stimulus, and that sent interest rates down, even as the vaccine, in theory, should have been more bullish for the economy. And so it was almost like the opposite of a perfect storm. for the market, and that it had two good things happen more or less at the same time: low interest rates, which are very bullish for the market, as well as the real prospect for the first time of a vaccine that could be a game changer within a reasonable time horizon.
So, Larry, what about the interest rate issue, and particularly the yield curve? Because it really steepened. It's come off that a little bit toward the end of the week. But is that yield curve telling us anything relevant right now?
You know, these movements are big in the slope of the yield curve relative to what we've seen lately. But by the standards of the longer term of economic history, these movements of 10, 20 points, if that, in the yield curve aren't that immense. So I wouldn't overdo the significance of those movements. And of course, movements in the yield curve are different when they're about real interest rates than when they're about nominal interest rates. I do think we're at risk of making a consequential error in not providing more stimulus. It may be that we'll be okay because there's a lot of cash that got built up from unspent stimulus in the past, but it may be that we're not okay. And so I think we're taking much more of a risk of a double dip than is prudent. And, you know, you look at what's happening around the rest of the world, and the risk that there are going to be some real financial aftershocks here is not something I'm prepared to predict, but it's certainly something that, as a policymaker, I would want to be insuring against.
Steve, as an investor, looking below the top line numbers on the equity indices, what did we see this week? Because tech had been driving things up, then tech came off some this week. It looked like we were at least flirting with some cyclicals and even some value stocks. What is that telling us about what investors are thinking?
Yeah, no, there was a significant rotation in the market this week. And again, it really related to the vaccine more than anything, because the cyclicals have been, you've had the greatest dispersion between so-called growth stocks and so-called value stocks or cyclical stocks. Certainly in my recollection, I think probably, in fact, I know essentially in history, where like we were at the 99th percentile of dispersion between those two fundamentally different investment strategies. And when the market perceived that there was a light at the end of the so-called tunnel, two interesting things happened. First, the cyclical stocks rallied enormously. You had airlines up 25% in one day, hotel stocks, leisure stocks, everything that has been really beaten up because of the virus. And at the same time, ironically, you had the growth stocks come off because people perceived that there might be less use of these things going forward. So you had Zoom stock go down, I think, 14% the first day after all this hit the news. And so markets, you know, Larry and I have had many discussions about the efficiency of markets, but this was a case where the market suddenly woke up and decided the world was going to be different than what it thought it was going to be, and you saw stock prices adjust accordingly.
Larry, we are on the border of a new era here with a new president, maybe a divided government, we'll see. But nevertheless, we're turning a chapter here. As a practical matter, what do you think the chances are that the Biden presidency, whether it's 1 term or 2 years, could be consequential?
I think that it will be made consequential by the magnitude of the events that going to deal with. It's going to deal with a reconceptualization of some kind of the U.S. relationship with China. These are going to be crucial years for the global effort on climate change. Make no mistake, the expected return time of some kind of pandemic threat, this is nowadays more like a once every 15-year thing than like a once every 50-year thing. And the world's going to have to get it together to be ready for the next one or not. And that's going to depend on what happens in a Biden administration. Perhaps most fundamentally, Abraham Lincoln talked about government by the people and government for the people. And he assumed that those two things went together. And you saw in the number of people who voted for Donald Trump, what you saw in Brexit, what you saw in Bolsonaro's election in Brazil, what you've seen with Modi in India, what you see in the greater attraction of the Chinese model to people around the world, what you see in the number of young people in the United States who profess not to believe in democracy as the best system is increasing doubt about the proposition that government by the people will always be the best government for the people. And fundamentally, that's the task of this administration, to reconvince people of that Central American premise, both in the United States and around the rest of the world. So I think succeed or fail, this is likely to be a very, very consequential presidency, and I'm optimistic, but no one can be certain.
Well, everyone has to hope for success, Steve, but as a practical matter, can President Biden deal with a Mitch McConnell if he is majority leader and make it a government for the people? Whatever one could say about that means, can he make fundamental change in what we're doing in this country?
That's exactly my concern about this, and I don't want anything else I say in this show at all to sound partisan, but I would say the following, which is that I understand why the markets, to some degree, and lots of people that we all know, think divided government isn't such a bad idea, checks and balances, limitation on what the president could do. But I worry a lot about, I agree with everything Larry said about the fears about democracy, the threats to democracy, the concerns that there may be a better system, that democracy isn't working. You look at China's success in getting past the virus and the way their economy is going to grow this year, unlike the way any other developed country is going to grow this year. There's a lot to worry about democracy. And I worry that divided government isn't going to help. We are living in an ultra-partisan environment. There have been, you could count on one hand probably the number of bills that have been passed by Congress in the last 4 years that had any kind of bipartisan support of one kind or another. Larry will be able to speak to this better than I can, but we were both in Washington in 2009 when the Democrats had 60 votes in the Senate until Teddy Kennedy died in August of 2009. And even then, it required Herculean efforts by many people in the administration to get even what got passed. Right. And so I think that this sort of slightly halcyon idea, which the president-elect has embraced, and I commend him for his optimism that somehow he's going to bring the two sides together, is I find quite daunting and quite scary, because the risk of failure is high, and that will not leave us in a great place.
At the same time, Larry, there are some things that the president and his cabinet can do almost without the support of the Congress. You wrote a memorandum, as it were, to the next Treasury Secretary, whoever that is, for the Peterson Institute for International Economics this week, in which you gave some advice about the international leadership we could give economically. That might not require full congressional support.
There's a lot that we can do. One of the very significant things that President Obama did was convene, along with Gordon Brown, a G20 summit three months after he was in office that really galvanized confidence by doing a whole set of international things with respect to the financial crisis. And we haven't seen anything like that so far with respect to this crisis, and that's an area where the next Secretary of the Treasury and the President-elect can show very important leadership. And if we can give confidence that the developing world is not going to be a source of crisis, not going to be a source of uncontrolled, contagious disease, I think we can improve materially the economic prospects for our country. If we can broaden understanding that of the nature of our economic problems, and they're quite different than they were a few years ago. We've got to figure out how to channel what is basically an excess of savings into productive investment. If we can make globalization more into an issue for regular people than an issue for elites, I think there are huge gains to be had from further cooperation on global tax evasion by profitable companies. And that's something where great progress can be made without changes in U.S. law. There are great changes that can be made simply in collecting taxes that are owed but not paid. There are far too many people with incomes of $10 million a year who didn't file their tax returns, and the IRS made no effort to trace it. because of budget cuts. So there's a lot that the President of the United States can do. I think it's a big mistake to underestimate the power of the bully pulpit well used. And I've been encouraged by the fact that Joe Biden has been very clear that he intends to be the president of all the people. And I think his willingness to avoid constituency politics in his party is likely to make him an effective user of that bully pulpit. And I think more people will come along than most people think.
There you have it, an economist and an investor giving us the balance of hope on the one side and caution on the other. Many, many thanks to Larry Summers, our special contributor to Wall Street Week. He is, of course, from Harvard. And Steve Rattner of Willett Advisors, who invests the personal and philanthropic funds of Michael R. Bloomberg. Coming up, how different will a Biden administration be from what came before, especially if the Congress is split down the middle? We talk with former Federal Reserve Board Governor Dan Tarullo.
There's an enormous amount he can do just by having control of the executive branch, but it is going to be important for Congress to at least be somewhat cooperative.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. 4 years ago, President Trump committed his administration to undoing much of what came before him, whether it was trade policy or financial regulation or international agreements. President-elect Biden has promised to reverse much of that course, but to grow the economy even as he pursues his goals on climate change, racial justice, and inequality. Can he do both? We asked Dan Tarullo, former Federal Reserve Governor, who held senior economic policy roles in the Obama and Clinton administrations.
He certainly can, David, and in both in the short term and in the long term. I mean, in the short term, as we've all been saying for 9 months now, getting a hold of the virus, getting a vaccine out is the single most important thing to continue a cyclical recovery. And that in and of itself will provide a substantial boost, hopefully through all of 2021 and into 2022. So there, I think, as we've all been saying, the public health issue is the most important economic issue in the short term. There is stimulus, I think there's a crying need for stimulus to carry us into the period where the vaccine is going to take effect. But after that, you are going to get some tailwinds, basically, from the recovery. Longer term, I think it's a question of whether the now president-elect is going to be able to manage to get Congress to go along with some of the spending priorities that he has. There's an enormous amount he can do just by having control of the executive branch, but it is going to be important for Congress to at least be somewhat cooperative.
Well, and when you talk Congress, as a practical matter, we're probably talking the Senate, right? Because as we sit here, we're not going to until late in January whether Republicans or Democrats have the majority. Right now, I think you'd probably say it's likely that the Republicans will. Is it possible for President Biden to do business with Mitch McConnell and get some things done that certainly knows we hadn't gotten done last time?
Well, I think I would say, David, if it's possible for any Democrat to do it, it's probably Joe Biden who can do it. He's not only a veteran of the Senate, but obviously has a longstanding relationship with Senator McConnell. But if we step back from personalities a bit, I think there may also be some motivation that at least some Republican, a handful of Republican members of the Senate may have. So consider, for example, in infrastructure investment. I mean, that elicits raised eyebrows now in Washington, New York, and just about everywhere else, because people have been talking about it as a potential bipartisan project, and it hasn't happened. But I think when you've got an administration, as we will, that has competence, that coordinates its policies, and that has a consistent set of policies, the chances of working something out become much greater.
So you dealt with economic policy certainly when you were a member of the Federal Reserve. But also, before that, in the Obama administration, in the Clinton administration, you really dealt with economic policy. As you look at the economy today, we still have a ways to come back. We've come back some, we still have ways to come back, and particularly when it comes to jobs. We've still got over 10 million people who don't have jobs today who did before the pandemic. Is infrastructure the best, quickest, more sure way to restore some of that to the economy?
No, coronavirus vaccine is the quickest and surest way to do it because that's what's going to get the service sectors back up and vibrant. I would say, David, the infrastructure investment is a medium to longer term project. It's one that would both improve productivity and create good jobs along the way.
That was Dan Tarullo of Harvard Law School. Coming up, we'll talk with Tom Montag, Chief Operating Officer of Bank of America, and Anne Finucane, the bank's co-vice chairman, about why they're taking the lead in issuing sustainability bonds.
It's hard to imagine 5 or 10 years from now, David, that everyone doesn't have bonds like this, quite frankly.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now for a global market week in review.
David, the vaccine breakthrough lit a fire once again under the value versus growth debate, which some investors caution will be short-lived, and rising virus cases served a reminder that uncertainty does remain, which kept Asian stocks from clinching a fresh record high. Signs of resilient Chinese consumption and Tencent's earnings and the single-day sales offered some relief. And next week, looking busy with global meetings from APEC to the G20, as well as the BRICS summit. And on the data front, it's a gut check on Asia's two biggest economies, with China's monthly activity data and Japan's GDP report due. Plus, 3 Southeast Asian central banks are on deck with policy decisions. Danny?
Thanks, Sophie. In Europe, Boris Johnson's leadership plunging into crisis. His most influential advisor, Dominic Cummings, has quit and said he would leave by the end of the year. He's just the second key advisor to leave this week and comes at a key moment for Boris Johnson as he deals with rising death rates from the coronavirus, as well as Brexit talks ongoing. They're set to continue next week as time runs out to ratify a deal before the end of the year. Scarlett?
Thanks, Danny. With COVID cases climbing to new highs daily, progress on a vaccine can't come soon enough. Pfizer's announcement this week that its vaccine had 90% efficacy raises the bar for Moderna, which is due to report its trial results any day now. Look for retail to be the main focus in the coming week. On Tuesday, Home Depot and Walmart report quarterly earnings. Target, TJX, and Macy's will follow up with their results. Meantime, the government's October retail sales report will likely show a slowdown from September's strength. And tech CEOs will be in the hot seat again. Mark Zuckerberg and Jack Dorsey will testify to the Senate on their handling of the 2020 election. David?
Thanks to Sophie, Danny, and Scarlett. Coming up, the election may not have gotten us past our partisan disagreements, but economist Paul Romer says the coronavirus may force us to do just that. Because in the world of the pandemic, there are no blue or red states.
People say, well, the blue states had it right, the red states had it wrong, they've got to behave more like the blue states. Neither of them did that well.
This is Wall Street Week on Bloomberg. On the campaign trail, candidate Joe Biden argued for higher taxes, cleaner energy, and more infrastructure. But a President Biden, if faced with a Republican Senate, may have to trim his sails and adjust his priorities.
I think a more reasonable outlook might be delaying large tax increases. We are, after all, in the middle of an incipient recovery, and focusing first on a recovery package, and then what I would think of as a renewal package.
President-elect Biden did not get the blue wave he'd hoped for, and the fate of the Senate leadership turns on the outcome of Georgia's 2 runoff elections next January, which underscores the importance of reaching across the aisle that Mr. Biden acknowledged in his victory speech.
I pledge to be a president who seeks not to divide, but unify. Who doesn't see red states and blue states, only sees the United States.
But to get the bipartisan support the president-elect says he wants, he may have to move away from some of the more progressive goals of the campaign trail to a more moderate approach to governing.
If it means a wealth tax is off the table, it means Medicare for all is off the table.
President-elect Biden is not waiting until January 20th to get started. He announced a COVID-19 advisory board that will be co-chaired by a former FDA chief, a former Surgeon General, and a professor of internal medicine. A member of that board warns that things will get much worse before they get better.
Remember that at Labor Day, we were at about 23,000 to 24,000 cases reported each day. Now we're reporting over 130,000 cases a day. We're going to have a serious crisis, much more than we've had already, just within the next, weeks to months.
There's no doubt that the pandemic is tightening its grip on the country. U.S. coronavirus infections topped 1 million in just the first 10 days of November as the virus makes a comeback pretty much across the country.
We crushed the curve, and now it's come back up. We think a lot of this is fatigue, including in private settings.
We asked NYU economist and Nobel Laureate Paul Romer what will determine the course of the next 4 years under a President Biden. And he began with the pandemic.
I think we need to adopt the mindset that we've got to find a better way to escape from this pandemic, to bring it under control. I'm afraid that this might turn into an exercise where people say, well, the blue states had it right, the red states had it wrong, they've got to behave more like the blue states. Neither of them did that well. The blue states had a lower death rate, but they've also had slower recoveries of employment back to where we were in January. So we need a new measure that's different from what either side was doing in the last 3 or 4 months. And I think it's clear what that measure is. Do what the NBA did. Do what Harvard and Cornell and NYU were doing. Test people frequently, isolate them, and then let's get back to business.
Now that seems pretty simple, but the simple can sometimes be hard because it's not clear people are going to comply with that.
Yeah, well, there was an interesting comparison of how New Jersey responded to an outbreak in the Orthodox Jewish community as opposed to how New York responded. New York responded with the more traditional public health measures, mandates, don't group together in big groups, don't do this, don't do that, wear masks. In New Jersey, they just started testing people and gave people the information. And this produced less of a backlash in New Jersey and more compliance, because once people started to see how many of them were infected, they took this much more seriously.
So as you say, we've got to figure out a way to do both, walk and chew gum, as it were, which is to say,
absolutely,
keep the economy as open as we can, at the same time protect people. But beyond that, there are larger issues over the next 4 years, 8 years, 12 years that we need to address with the economy. And we have some people saying, look, in order to really get growth going again, because as you know well, Professor Romer, we've not had really growth rates with the developed countries for some time the way we did before. We need some massive thing, something like a Marshall Plan, effectively, to really invest in the economy. By the way, we could use the infrastructure, and we need to move to green technology at the same time.
No, you're absolutely right. If you look at the growth over this entire recovery up until the pandemic, both like the second Obama term and the Trump term, this had the lowest rate of GDP growth of any recovery since the end of World War II. So there is something deeper, structural, that we have to address. And, this is a time when borrowing is inexpensive. This is the time to go big on borrow and build. So I hope we can reach a consensus on the kinds of things we could borrow and then build to make the country better.
But I wonder if the politics permit that today, because I wonder, Professor Romer, whether you can get the payback in productivity from education within the life cycle of a president, for example, of 4 or 8 years. Is that a longer term, almost generational move?
I'm afraid the things that could really change the quality of life for my grandkids when they're working adults aren't going to pay off in a big way in the life cycle of an administration. So it will take some time, I think, to rebuild a consensus in this country that there's some things we do because it's the right thing to do, and because we believe in the future of this country and we care about our future citizens. But I think we can get back to that place. Things are bad right now, but they're not as bad as they were during the Civil War. That was Professor of Economics Paul Romer of NYU.
Coming up, taking ESG investing to the next level with bonds tied to economic and racial inequality. With Tom Montag, COO of Bank of America, and Anne Finucane, B of A's co-vice chairman.
ESG is sort of a good reflection of our strategy of responsible growth.
This is Wall Street Week on Bloomberg. ESG, environmental, social, and governance investing, is all the rage. But how far can it go? Bank of America has been a leader in sustainable investing, and it's not limited to the environment or to governance. Last month, B of A issued a $2 billion sustainability bond tied to equality, with proceeds going not just to clean transportation and energy, but also to alleviating inequalities in Black and Hispanic Latino communities. Tom Montag, Chief Operating Officer of Bank of America, and Anne Finucane, the bank's co-vice chairman, explained the how and the why.
We had made our $1 billion pledge for racial equality. And after that, because we've been a leader in the green and social bonds, we decided it would be good to provide a blueprint for everyone else to be able to access this market. And so we put together the $2 billion sustainability bond, and it was green and social, as you say. The difference for this was the social aspect of it was all for financial empowerment for Black, African American, Hispanic, Latino communities. And so the entire social aspect is there. And I mean, this is hard work because once you do that, you have to track the things that you're doing and make sure you're doing them. And so it was a lot of work internally and with finance to be able to have the tracking elements and know what we were going to do. So we track how much we do in affordable housing. We track how much we do for health practices. We track supply chains for minorities. And so all those things are part of the social aspect, David. So this was $2 billion. We had incredible demand across from corporate treasurers and from investors. And so we were very pleased with it. It's interesting. I think you'd like this, that 5 years ago in 2015, there was $38 billion of green, social, sustainable bonds. This year, there'll be almost $400 billion. So, and we've been, so 10 times in 5 years. And so we're really pleased with the bond and what's happened. And by the way, it's part of how we work here. I was looking yesterday at affordable housing. Last year, we had over 8,000 affordable housing units that we helped finance. And of those 8,000, David, almost half of them, were green themselves. And so we've tried to take green and social in a lot of the things we do. So we were so excited about this bond and what it represented in the blueprint it set for America.
So Anne Finucane, as Tom just suggested, this is part of a larger plan, a strategy for Bank of America. Put it in context. How does this fit with the other things that Bank of America is doing?
Thanks, David. Well, ESG is sort of a good reflection of our strategy of responsible growth. How could you be responsible if you're not thinking about sustainability in the long term? It's also, as Tom is laying out, a very good business opportunity for us. We probably represent about a quarter, 1/4 of the social or ESG bonds that have been issued and underwritten in the last 8 or 9 years. Also, it's just been, and we meet with maybe the top 50 institutional investors, all of them are asking about this. All of them expect for you to be progressive in this regard and to do more. And our employees care about it too.
Tom, what about the accountability for all this? I'm not even necessarily talking about Bank of America, but in general, there's a lot of people saying they're doing environmentally sustainable things good for the social compact. How do we know that that's true? Because we don't really have standards yet, do we?
Well, we have standards, and the standards that we literally have our auditors come in and make sure we are doing the things that we list that we're going to do. And so it is a well-tracked process. David, we have, as I said, $10 billion of these type of bonds outstanding, 5 green bonds, 2 social. We did a COVID bond also this year, which was $1 billion, and this $2 billion sustainable bond. So all of those bonds have a list of things that the proceeds can be used for, and that list is tracked and maintained and audited to make sure we're doing that.
Tom, talk about the possible consequences for the investment community overall. I guess my question is, how big could this get? You mentioned that all sorts of new records are being set in things like the issuance of sustainability, other kinds of green bonds. So how big do you think it could really get? What's the future for this?
Well, it could be the entire market, couldn't it? I mean, if you really thought about it in some ways, I mean, you can imagine, I'm just thinking about in the news now is the Paris climate treaty and how you could work those kind of things in, how you could work in different, it's every company is going to have a different way. It's different for a bank than it is for a manufacturer, this for an airline. And so everyone has to find the things that work for them. But, culturally, it's just a good thing. It makes you think about it. It drives the organization to think about it in everything you do. And so, we've done a lot of research, our Bank of America research on ESG and how good companies practice ESG better than other companies. And so it's just a good mindset to have when you do it. And I think that people know that, investors want that. And that's why it's growing as fast as it is. It's hard to imagine 5 or 10 years from now, David, that everyone doesn't have bonds like this, quite frankly.
As Tom says, this is probably what every company will have to look at. If by 2050, we have to be net zero, and before that, carbon neutral, that means that every single company will need to look at their carbon footprint. That will require financing, advisory, M&A potentially. They need to buy offsets often because they can't fully get to carbon neutrality without it. So these are all business opportunities for a financial institution.
Tom, give us a sense of what comes next without revealing any state secrets at Bank of America. You've just done the $2 billion sustainability bond. Are you going to wait a while and see how that goes, or are you going to be looking for further issuances coming up in the coming quarters?
Well, we're as a business, we're talking to many companies around America and the world and issuing them themselves. And so, now we're on the other side of it, where we're showing them how we did it and how you can do it, and providing the blueprint and trying to get momentum for more people to issue these kind of bonds. The green part of it, David, happens all the time. It's the social part that's a little newer, or sustainability part. And so that will take time to get going. But, there's been many companies that have done it already, and you've seen it in the market. So I just think it'll just keep on growing, quite frankly.
So, Ann, we've mentioned the initiatives of Bank of America, which go well beyond issuing sustainable bonds, although those bonds are part of the initiative. How do you measure success? When you go into Brian Moynihan, you mentioned Brian Moynihan, how do you say, see, we're getting done what we want to get done?
Well, I think we've been able to demonstrate success on any level. On a macro basis, the company is doing well. We are, I would say, the leading ESG bank in terms of we're the largest underwriter of green bonds, the largest tax equity financer. So we have some tangible business. We've done $160 billion worth of business over the last several years, and we see big opportunity, as we've outlined, in the future. Our employees note that this is important to them. Our clients note that this is important to them. Our institutional investors say they care about this. And as I've mentioned before, I think we're going to see regulation that follows legislation around the world. So getting to net zero by 2050 is both a big task and a great business opportunity.
Tom, Ann has mentioned more than once the possibility of regulation dealing with governments, and some governments, at least around the world, have been sort of nudging investors in this sort of direction. If you didn't have government sort of nudging, as I say, in one direction, and by the way, you didn't have close to zero interest rates, would these bonds still work? I mean, how much of this is really a search for yield in a time when it's hard to find very good investments?
No, I think they would still work. And I listen, any market has sometimes a nudge gets it going, but that nudge was a long time ago. And now this is what investors want and people want. And the generations that are coming up want this. They want people to do these types of things. They want us to do ESG. They want us to invest in and support these things. And so the money that they're raising, the investors are raising, is ESG linked, both in the equity market, quite frankly, and in the debt markets. And there's so much research now, David. There's even ETFs that are ESG related. So it is the future.
That was Ann Finucane, co-vice chairman of Bank of America, and Tom Montag, the bank's chief operating officer. Coming up, we continue the ESG discussion with contributor Afsaneh Beschloss, founder and chairman of RockCreek. This is Wall Street Week on Bloomberg.
Pension funds, individual retirement accounts, and all growing so rapidly, and the quantity of shares available to buy is shrinking, so that in the long run, share prices are likely to be much higher than they've ever seen before.
That, of course, was Sir John Templeton speaking on Wall Street Week way back in 1987. He was explaining at the time why the growth of pension funds and IRAs was driving up the price of stocks. Now, 33 years later, we have stock prices going up once again, and this time near zero interest rates just may have a little something to do with it. For her take on the markets and investment opportunities, we welcome now Wall Street Week contributor Afsaneh Beschloss, founder and CEO of RockCreek. Afsaneh, always a pleasure to have you with us. So we had a record S&P 500 and Russell this week. There's a lot of news out there, including about a vaccine. But how much of this was really because the interest rates are close to zero?
Obviously, David, a lot of it did have to do with the interest rates being at the levels they are. But we can't forget the fact that a very major thing also happened, and that was the removal of uncertainty. And the fact that markets and people realized that there is the election results were final in the U.S., or they will be final soon, but that President-elect Biden will be taking over. And I think that certainty and the fact that he and his administration would bring more certainty to markets was huge. The other thing, obviously, was the news on the vaccine. So you put together interest rates, certainty or more certainty, and vaccines. That's a pretty potent mixture.
Yeah, there was some uncertainty inserted as well, including by the Trump administration, albeit on the way out, as they announced that you couldn't invest in certain specified Chinese stocks because they said they were associated with the Red Army. What about that? What about possible uncertainty over the next couple of months? Because we're not sure exactly what the Trump administration might do.
You know, it's interesting because the news just came out from nowhere yesterday, as you mentioned. And there have been some conversations about limitations on U.S. investors in buying the equities in China that are related to the government, in particular defense industry. But the timing of this was interesting. Some people even said it was related to maybe knowing that President Xi was about to congratulate President-elect Biden. But as you said, there's going to be a lot of things like this between now and January. The main thing, though, which was very interesting, the majority of these stocks are held by non-U.S. investors in any case. So it's not like it's going to impact prices too much. U.S. investors obviously were scrambling a little bit in terms of, you know, the fact that some of them might have a very tiny amount of allocation to some of these stocks. But then if you read the fine print, Treasury has said that you can dispose of these stocks until almost the end of November or middle of November of next year, so a year from yesterday. So it's one of those things, you know, as we've seen with TikTok, which went back and forth, and at this very moment is sitting in sort of limbo land. We don't know really what will happen with these particular stocks, but it was not anything that was major for the market.
So, Afsaneh, throughout this tumultuous year, you have come on Wall Street Week and you have talked about ESG stocks, a basket that you follow, environmental, social, and governance. Are they still holding up the way they were in an uncertain world?
Absolutely. And I think what is really interesting is that as our lifestyle has changed, even, you know, as you mentioned, the changes in the market where we had value stocks have their biggest day in a very long time also recently. During that same period, two things have happened. One is that investors themselves are trying to look longer term and starting to value things beyond capital and labor. They're starting to look at carbon as a risk for a company, and they're starting to measure it even if there's no carbon tax. The second thing that has happened is the opportunity set, and COVID just expanded the opportunity set or brought it forward much faster. So things like what you just had, for example, Finucane talk about, which was fascinating in terms of their very big bond issue, I think is going to be really, really consequential. And we're going to have a lot more of both equity market and bond market developments in ESG.
As you compare ESG baskets with others, are they holding up well? In the past, you've reported that they actually are beating others on return. Is that still the case now?
Absolutely. They continue to both beat the non-ESG stocks, if you want to call them that. And secondly, they are expanding. So you're seeing, continuing to see not just in the first quarter and the second quarter of this year, but also in the third quarter. And as we speak, more assets go into these. And it was the ETFs and some of these mutual funds that started the trend. But as we're talking, a lot more money is going into private areas, private equity, venture, and also other private areas like in real estate and infrastructure, of course, which is a huge growth area that is taking on ESG assets. So you're seeing it both in performance and asset flows. And by the way, the other thing to mention, David, is that these assets, particularly if you're going into climate-related and energy-related, are huge creators of jobs. So it's not just a question of climate change, which obviously everyone cares about, but it is also about creating the future jobs. And by counts that you see at WRI and elsewhere, 63 million jobs by 2050.
And that's before the Biden administration comes in, which seems to be a friend of ESG. We'll see how that plays out with the divided Senate. Thank you so much to Wall Street Week contributor Afsaneh Beschloss. She is the founder and the CEO of RockCreek. Finally, one more thought. What would we do without the Turks? This week, the world got its hopes up about a vaccine candidate that may just be the answer to so many of our problems. Backed by Pfizer, a pharmaceutical giant headquartered in New York, and, oh yes, a much smaller biotech startup firm from Mainz, Germany named BioNTech. But it turns out there's a deeper collaboration here, one that may have a lesson for us all. For it was BioNTech that was pursuing the messenger RNA underlying the new vaccine, and BioNTech comes from the collaboration of a married couple who would not have started their German company, quite possibly would not have even been together, but for Germany's willingness to let them and their parents immigrate from Turkey. BioNTech's CEO, Ur Şahin, moved to Germany when he was just 4 years old, and his dad took a job in the Ford plant in Cologne. Mr. Şahin's wife and the chief medical officer of BioNTech, Özlem Türkçü, was born in Germany after her parents also moved from Turkey. So, one of the brightest hopes for the world to overcome the coronavirus was the product of immigration. Immigration that Chancellor Angela Merkel permitted at great personal political cost, but without which we might never have had the vaccine candidate on which we are all so fixated now. But it doesn't end there, for BioNTech is collaborating with Albert Bourla. He's CEO of Pfizer and a Greek, pulling together products of two countries that have been at odds for hundreds of years and remain in conflict today over Cyprus, over islands in the Aegean Sea, and over oil and gas in the Eastern Mediterranean. So, at a time when the world is looking for hope, we seem to have found it, at least for the moment, raising the bar for the rest of us to work together to overcome our challenges, whatever our differences. That does it for this episode of Wall Street Week. I'm David Westin. See you next week.